and people just love real estate, right? That's what people don't realize, right? Again, they just look at price, point-to-point price. And the other thing is that actually people don't realize how volatile real estate can be because there's no mark to market, right? It's not like you have a ticker in front of your house, like you have the Bitcoin ticker that will say, okay, now Peter's house is up, 10%. And if you had the real market for your house on the day, I guarantee it would be extremely volatile. It's raining a lot, maybe there is a flood that it's coming, your price is gonna crash, right? Oh, now it's great, and your neighbors are moving in, the development of then it go up significantly, right? And there's another thing, like there's massive distortions in real estate.
Within the realm of investments, few assets possess the allure and enduring appeal of real estate. Its tangible nature and historical significance have long positioned it as a cornerstone of wealth accumulation. However, beneath this surface of lust lies a complex tapestry of factors that shape its true value. The CIO of Swan Bitcoin, Raphael Zagury, challenges the conventional wisdom surrounding real estate, advocating for a closer examination through data and analysis. Through his insights, Zagury unveils the intricacies that define the ever-evolving landscape of real estate investment and why, with the existence of Bitcoin, real estate is no longer the asset it once was. Stick with us until the end to find out why Bitcoin will progressively demonetize the monetary premium that comes with owning real estate.
People love real estate, right? It's the biggest asset in terms, I think, of monetary premium. And if you actually look at real estate, look in the US, look what has, use the Case-Shiller Index, which is an index that can measure price of real estate across different areas. And what you'll see is that most of the metropolitan areas, they have a very small premium to inflation. So it's like 2% above inflation in terms of price appreciation. Then you include that you have to pay maintenance, that you have to pay property taxes, that, there's something that always goes wrong that you need to fix. You're in the red. So people have this illusion that, real estate is this great store of value because they're locked in, right? So they're locked in for 20 years in an asset. Of course, it's going to go up. Did it keep up with inflation and protecting the purchasing power? Probably better than leaving the money in the bank account. Definitely better than leaving the money in the bank account. But there are other assets out there that probably have done better than real estate, and people just love real estate, right? That's what people don't realize, right? Again, they just look at price, point-to-point price. And the other thing is that actually people don't realize how volatile real estate can be because there's no mark to market, right? It's not like you have a ticker in front of your house, like you have the Bitcoin ticker that will say, okay, now Peter's house is up, 10%. And if you had the real market for your house on the day, I guarantee it would be extremely volatile. It's raining a lot, maybe there is a flood that it's coming, your price is gonna crash, right? Oh, now it's great, and your neighbors are moving in, the development of then it go up significantly, right? And there's another thing, like there's massive distortions in real estate. People, if you look in the US, right, there's massive subsidies for you to buy real estate. You buy a mortgage, you can deduct the taxes of the mortgage or if your the interest or if your taxes, right? And that just creates more incentive for people to leverage up, to buy the asset, and to feel less because the calculation that the typical American family will make in terms of real estate is like, how much can I afford every month? And then they will walk backwards to that. I say, okay, yeah. I have excess cash of $1,000 every month. I can afford $1,000 mortgage. They're not worried about the interest rate they're paying. They're not worried about that price house that they are paying for, right? And again, they're completely dissociated from any valuation, which if price go up significantly, as long as they can afford the house, they don't care, right? Now we're heading into a situation that, again, prices are really, really stretched up, right? Interest rates are high, and that's going to create all series of different problems out there. And again, real estate, ultimately, so I say it's a Frankenstein asset. Yeah. Because it shouldn't be used to store value. It should be used for it to live, and should be a nice house, which is the way that it was. And people should save money whenever they have enough money. They go out and buy a house, right, with the money that they can. But it became this Frankenstein asset where people just put their capital in there with Airbnbs and all of that to store value in the long term because they don't have an alternative. They're not, everybody's, in their own mind, everybody's rational, right? And it is a rational decision because they know if they just leave the assets standing in their checking account, it's going to be debased, right? So this is probably, and it's something that people understand. Everybody needs a house. I think people are driven by two different motives, right? It's fear and greed. So far, if you look at the developed countries, right, in terms of real estate, it was a lot of grade. People know that they put the assets there, and they know that prices are going to go up in real estate in their mind, right? It's starting to, while in places like Brazil, Argentina, Venezuela, it's more on the fear side, because we know that if it's not there, it's somewhere else, right? That's going to be debased. It doesn't matter. It leads to a lot of people going to one asset class, a $320 trillion asset class, right? We're celebrating that we just saw $1 billion going to ETFs, in one day. It's nothing. It's a drop in a massive ocean of liquidity in the world, right? And my point is that all this liquidity and it's not only real estate, you're talking about, all the way from Japanese stocks in the 80s, right? Internet stocks, then we had all kinds of different bubbles, real estate bubble, and all of that. It's because we have excess liquidity in the system that needs to go somewhere. And if you have an asset that can capture even a small percentage of this massive ocean of liquidity, even with a very small probability in your mind, and even that it doesn't happen today, it happens in 10, 20 years, that asset should be valued much more than what it is right now, right? And this is why I come to Bitcoin. I always look at the numbers and I'm like, this is by far the best asymmetric bet that you can make, because even in very low probability scenarios, if it captures the monetary premium of all these assets, right, the upside potential, we're not talking about 10x. It could be 100x in a very quick period of time if it really captures the monetary premium of these assets, right? We always confuse, when you look at valuation models, let's say we all come to an agreement that the fair value of Bitcoin tomorrow, for some reason, we open up a door, we can all sneak in the future, know that Bitcoin is going to be priced at $600,000 1 month from now, right? And we know that for certain, right? What's going to happen is that overnight, you're going to have such a massive flow to come into Bitcoin that who knows what's going to happen to price, right? And price may go above the 600,000 because, there's only a few of us that are going to be willing to sell. And very quickly, a massive market order comes in to buy Bitcoin, and the price could go even higher than that 600,000. You also have players that come in and say, yeah, I saw that, 1 month from now it's at 600,000, but if 1 month from now it's 600,000, it probably means that it's capturing a lot of monetary premium. It's not going to stop at 600,000. It's going to probably go higher. So I'm willing to pay more for that, right? So as economic participants start to, on their mind, create the probabilities and see the fair value on their minds, you could have a monetary premium on Bitcoin in the short term because of flows, right? It's a very narrow door that a lot of people are going to try to get out at the same time.
Today's video is sponsored by Stampseed. Don't store your Bitcoin in cold storage without stamping your seed phrase on an indestructible titanium plate. Stampseed is fireproof, rust-proof, impact-proof, and easy to hide. It has no loose parts and will give you ultimate peace of mind that your Bitcoin is safe and sound for the long term. Click the link in the description below for 15% off your stamping kit. Welcome to Bit Intelligence. We are committed to bringing you top-notch Bitcoin-only content, twice weekly. Doing this is quite a lot of work. If you are enjoying it and you'd like to support us in making more of these videos, subscribe to our channel and hit that bell icon. If you are willing to go a step further, consider contributing to our Lightning wallet on Geyser to help us get the funding we need to keep bringing you these videos. You can also join our channel here on YouTube for as low as $2.99 per month. Okay, back to the video.
I remember back in November, like a year and a half ago, watching it, coincidentally, at the same day, I watched I think it was the first time that Michael Saylor was talking about Bitcoin as property. And on that video, he said, okay, so here's a real estate and Bitcoin is going to, be the best property that we ever had, right? And talking absolutes about that, like this is going to happen. And then I flipped to Bitcoin Twitter and somebody had just posted something about Dan Penna. You remember Dan Penna, the crazy guy? Oh, Bitcoin is going to zero, Bitcoin is going to zero. Always, it's also talking absolutes, right? The answer is not one or the other, it's somewhere in between, right? And I love probabilities. I love probabilities since I was very young, right? And I'm like, okay, so let's put probabilities to these scenarios, right? Let's first understand the scenarios, and then we'll put probabilities to them. And then the third variable is, the monetary premium is not going to be captured overnight. It's going to take some time. It may take 5 years, 10 years. So let's put another variable, which is time. So let's assume it happens in 10 years, and then we'll bring it to present value. And what that will do is we'll give us an idea of the ranges of price that Bitcoin could be. be. So let's use real estate as an example, right? Real estate, $320 trillion market out there, right? And think for an example, and again, people can go to the website and can change the assumptions. I actually created an app that you can slide up and down the probabilities, and you can change all of these variables for all different asset classes. You can include other asset classes. It'll be super flexible. So if in real estate, say, okay, 50% of the price of the 320 trillion, let's assume 50% of that amount is because monetary premium. So people that bought real estate, not because they're going to live in it, but because they either are a fund that want to get exposure, or somebody that wants to have an Airbnb, somebody that just has assets in excess liquidity that needs to go somewhere else, right? So that's the first variable. Assume again for a second that 50% is the right number. The second one is just say, okay, but it's not in all, if we think about a multiverse, right, several universes, it's not in all these universes where Bitcoin is going to capture the monetary premium. It's only in a few, right? So you put probability, say, okay, I think that maybe, I don't know, 10% of the universes out there, the possible scenarios out there, Bitcoin is going to capture this monetary premium, right? So you apply that as well. And then the third one is say, okay, so let's assume for a second that this is going to happen in 5 years, 10 years, and you apply a discount rate, you bring that to present value, and what you're getting, fundamentally what you're saying is like, if I believe that Bitcoin can capture with a small probability the monetary premium, which I assume is X of these assets in 5, 10 years, 15 years, this is the price that Bitcoin should be today. Not the price that it's going to be in the future, the price it should be today, right? That's what the model does. So the model does that for stocks, for bonds, for real estate, for art, silver, gold. And again, you can add other, I would argue there are other assets that are not included. There's cattle, there's like all different kinds of commodities that people use to store value, even currency, right? That should be in there as well. So this is a conservative measure. And then I have different scenarios there. I say, okay, each of these, let's keep the funny thing here. I do the opposite as well. So in these conversations with the TradFi guys, right, I'll do the opposite most times. I'll say, okay, so I understand you think Bitcoin is worthless and it's not, but is it 100% of the times? What's the probability that you think that Bitcoin is going to succeed? And they will give me a probability. I say, oh, I think 10% is going to succeed, right? Like, okay, so you think, if you look at real estate, let's switch topics, real estate, right? How much of the value of real estate out there, you think it's just monetization because people buy as a second home? So they say, I don't know, 50, 60%. And I plug these numbers in. Most of the times when I do that, it turns out that they're more bullish than I am. And I go back and I say, listen, with the numbers that you just gave me, Bitcoin should be worth today, right? This amount. And they first reaction is that the math is wrong. They're like, no, the math calculator, you can do it in your iPhone, like pure multiplication. There's nothing complex about it. And they do the math and you're like, damn, you're right. Even in small probability scenarios, if Bitcoin does capture this monetary premium of all these assets, right?
Amidst the mosaic of investment opportunities, real estate stands as a symbol of both stability and volatility. Raphael Zagury's work illuminates how its perceived value often obscures the intricate dynamics at play. By dissecting market forces and unraveling complexities, Zagury offers a sobering yet enlightening perspective on real estate investment realities. As the financial landscape continues to evolve, his insights serve as a guiding compass, navigating investors through the shifting tides of a complex economic landscape. Raphael describes a future that will inevitably be shaped by the existence of Bitcoin. Thanks for tuning into our channel today. If you want to watch another, try this one here. We'll see you next time.